European markets are waking up, but is momentum built to last? After months of drifting, European markets just kicked off Q4 with fresh energy, posting their best week since May. But the Stoxx 600 is still trailing the S&P 500 as investor caution lingers. The euro area economy may be holding up, but is this the moment that European equities are finally turning the corner? Benedicte Lowe is equity derivatives strategist for Europe at BNP Paribas. So Benedicte, JP Morgan says that the risk reward in the Eurozone is finally tilting positive. Are you seeing the same shift, or is the optimism premature?
So the EU tailwind that we mentioned in early September on why we were bullish on European stocks are still very valid as of today. We're going to have the impact of the German fiscal stimulus that will start to feed through to the economy. While it might be mainly via the confidence channel in 2025, that still should be some positive print ahead of us. We also have the fact that positioning is on the lighter side in Europe, and that earnings expectations are overall quite low for European stocks. So the bar to perform in Europe is actually quite low, and we think there's further upside for stocks into year end.
Let's turn to politics though, and France was just hit with a surprise PM resignation this morning. Could political risk become a bigger headwind for equities, especially with French elections looming?
Now, the reality for French stocks as a whole is that they've already underperformed a lot since the snap election of 2024. It's one of the main laggards also that we saw this year with the SMI, with a lot of negative news already in the price on French equities. So we saw a sell-off early this morning on the back of the resignation of the PM, but we've seen a bit less sensitivity to negative news with a lot of negative news that is already priced in. And same picture when you look at vol markets with a lot of risk already priced into French equities.
Let's dive deeper into that German long-awaited fiscal boost, and it is about to kick in, but questions are emerging around execution. When should markets realistically start to feel the impact?
Our economist kind of assumption is that the positive impact will start to be seen through the confidence channel first for 2025. And in 2026, we will really start to see the positive impact on the hard data. Now, the question for equity market is that they tend to price positive news ahead of those happening. So we think that signal coming from increase in confidence, whether it comes from the consumer, from corporates as a whole, will be seen as positive tailwind for equity markets, while equity market won't really need to wait for the hard data to pick up before pricing in some upside for stocks.
Well, earnings expectations are low for now, but 2026 forecasts have jumped over 12%. Are companies really in a position to deliver on that optimism?
So what we saw at the previous earnings season in Europe is that it was quite disappointing overall. We had some headwind coming from a higher euro dollar that was negative, but also as a whole, we didn't see really that pick up in the cyclical recovery story that we've been waiting on for months and months. Now we're getting into basically a period where the macro data should start to pick up, as I mentioned, on the confidence level. So hopefully that will start to be seen also from a corporate side at the next earnings season. Now there's a question around timing. Will it be the upcoming earnings season or the next one? That is still remain a question mark. But overall, we are heading into a territory where the positive news on earnings should start to feed through into equity markets, also in Europe.
So finally, Benedicte, the stronger euro could weigh on growth though, but with inflation sticky, do you see any chance that the ECB cuts again, or is that off the table for now?
Our view is that the ECB will remain on hold. If we take the case of European equities and what that will mean, yes, we have the Fed that is in an easing cycle and the ECB on hold, but the reality is that the impact of the past ECB rate cuts are only starting to feed through the economy right now. So we should get those positive tailwind of the past ECB cuts that provides overall this positive environment also for European stocks.
That was Benedicte Lowe from BNP Paribas. Don't forget, you can watch more videos on Reuters.com.